What's up, apes? Welcome back to the Daily Peels video stream / podcast of the day. My name is David. It is currently 7:58 p.m. on this beautiful Tuesday, July 9th, 2024. Thank you all for joining us. Solid day for markets out there, thanks to our boy Jerome Powell, which we'll be talking about in just a quick second. That's our big story of the day. He was out there spitting some game on Capitol Hill as always. He had his I think his secret admirer, Elizabeth Warren, was roasting him a little bit more than usual. So we'll get into all that in just a quick second of what that means for markets, your portfolio, and most of all, your wallet. But before we do so, let's talk about our collective portfolio, the WSO Alpha portfolio. You better go subscribe to that if you haven't already. I mean, it's a slap in the face to me every day that goes by that you don't subscribe, especially today, because we actually just published our first sell report on a stock, and of course it was up on the day, probably because people are just gearing up to short it. I can only imagine after seeing our analysis. It is a cannabis stock as well, so take in not necessarily a contrarian view, but a little bit different of a view on the outlook for cannabis stocks going forward. So make sure to subscribe to Alpha if you want to read that research. We got another piece coming at the end of this month on a company that I think a lot of you will enjoy quite a bit. Here's a hint for those of you watching the video, but they make this product right here that we've been writing about a good bit recently. Anyway, before I step on more of our content, let's go ahead and talk about what Alpha did today, up 0.16%, completely embarrassing the S&P 500, which was up only a puny, pathetic, embarrassing 7 basis points. I couldn't even show my face if I was one of those S&P 500 stocks today. The NASDAQ, was up 18 basis points, whatever. Fuck that, they beat us, whatever. They're both still beating us on a year-to-date basis, but still, I don't cry myself to sleep about it whatsoever. So whoever said that I do, you couldn't be more wrong. Anyway, before I do start crying, let's move into some of the banana bits. Like I said, Chair Powell was spitting some game on Capitol Hill today. He really set the stage for cutting rates. We'll talk about exactly why in just a minute. Moving on, housing inventory is finally moving in the right direction. And of course, by that, I mean it's moving up and to the right. So we're actually growing housing inventory with a ton of new homes coming onto the market. Obviously, my dumbass finally got an offer on a house accepted. So I officially will not be homeless after September 8th when my lease ends here at the current Daily Peel Global headquarters. And we head to the new Daily Peel Global headquarters up in the Northeast. So obviously it just had to work out like that. I'm sure prices are going to plummet. Rates are probably going to go down. An asteroid might hit the earth and make this all moot. And I'll still be fucking bankrupt somehow. I'm sure that'll be how it goes. Anyway, let's move off of housing for a quick second and go back to the stock market, because Morgan Stanley's CIO woke up this morning and decided to just be a fucking hater. He basically came out here and said that he expects the S&P 500 to fall a solid 10% heading into the U.S. election. I can't imagine why. I mean, we have two great young buck spring chicken candidates, both ready to lead the nation and definitely not press the nuclear button in an Alzheimer's, dementia-ridden fit or anything. So I don't know why he could possibly feel like that. And finally, corporate bankruptcies are on the rise. Maybe that's why he feels like that, because companies are apparently doing pretty rough. So definitely not a perfect scenario going on. We'll be talking about bankruptcies more later on this week, and I'm pretty excited about it because it's going to be an interesting story. But let's go ahead and move on into our main story of the day. We are talking about the roast of Jerome Powell. Now, I'm sure a lot of you recently watched the roast of Tom Brady on Netflix. That's a tough one to do after winning 7 Super Bowls, going to like 11 Super Bowls, I think, in total. I'm a Patriots fan. I should know that shit, but I don't count the Bucs seasons. And he's dead to me after he left New England. I mean, he had a 13-year marriage to literally the most famous supermodel in the entire world, a woman that actually made more money than he did. He's made over $500 million. He has a beautiful family, and still, everybody was roasting him. Now, the roast of Jerome Powell is a whole lot easier, so that's why they had a lot of comedians come in and roast Tom Brady. They needed professionals to get the job done. For Jerome Powell, they could take the idiot senators, basically the dumbest people in the United States, come out there and roast him, and it went pretty damn well, especially because the market was up on the day. Yields moved lower, which depends on, your basically how much money you have, how you feel about that kind of stuff. But let's go ahead and talk about exactly what went down. So basically, Jerome Powell stood up there in Capitol Hill, and well, it looked like he was standing on Capitol Hill, but he was actually standing on business. So what he was doing was basically defending the policy and regulatory decisions of the Federal Reserve to the Senate Committee on Banking, Housing, and Urban Affairs is technically what it's called. This was, nothing really changed here whatsoever. So we can see right now the odds of an interest rate cut coming by December or the end of 2024 currently sits about 23.3%. Now that is up from the 22.5% the day prior, but really the main odds are that there's going to be 2 cuts by then. So we're seeing the probabilities of 2 cuts rise by about 0.5%. So not a huge move in either direction as a result of this, but the fact that they are still increasing is giving us pretty good hope, especially because Powell did engage in that classic Fed speak here today. So we are here to translate once again. So it kind of started off getting roasted on like bank regulations. Senator Elizabeth Warren from my home state of Massachusetts, God, we are so proud of her. She was up there flexing her complete lack of awareness, absolute void of economic knowledge going on in her brain, roasting Jerome Powell for a solid 5 minutes. Definitely watch the clip that I'm linking to in the piece tomorrow because at the very least, it's going to give you a good laugh. But besides her, general political shenanigans, chicanery, if you will, really tomfoolery, I think is the best way to describe it. They actually did talk about something that matters and is real for the economy, which is, of course, the path of interest rates. So senators, they don't necessarily care about what it's doing to the stock market. Obviously, that's all I personally care about, but they're more focused on things like housing, the labor market, stuff that actually matters to non-virgin market nerds like myself. Nonetheless, basically, what they talked about was what the plan is going forward. They were essentially saying like, hey, unemployment is on the rise. What are you going to do about it? What are we looking at for the path of interest rates going forward? And so as we can see by this next chart right here, this is plotting the one-day chart of the 2-year Treasury yield. We can see that going into the conversation, the market was a little bit uncertain. So they sent yields higher because who the fuck knows what Powell's going to say when he gets up there. But nonetheless, as soon as he started commenting, yields fell right back down because he made a little bit clearer that the path of interest rates is lower for sooner, as we've been saying for quite a while now. But essentially, he didn't give a timeline or anything. Like, basically, to translate exactly what he said, he basically came out there and said, we're going to cut rates. We don't know when we're going to cut rates. We don't know how much we're going to cut rates by, and we don't know if we're going to do any other monetary policy loosening maneuver, such as, slowing the balance sheet runoff or even growing the balance sheet again. If they do that, I'll fucking put a gun in my head. Nonetheless, he also suggested that macro risks are now starting to lean very clearly more towards a slowdown and a recession rather than re-triggering inflation. So we do expect rates to move lower by the end of this year. He didn't say that explicitly, but that is the Fed speak messaging that he was basically sending to markets, or at least that's what I heard during his testimony. So like I said, we still don't know how, we still don't know when, we still don't know what's well, we do know the what, but we don't know the how or the when. Really, those are going to be the important things going forward. So stay tuned. It was an increase in certainty that rates are going to be coming down, but a decrease in certainty, or not necessarily a decrease, basically remaining the same in how uncertain we are about when that's going to happen, what it's going to take. But it's clear as well that Powell is kind of looking more so at the labor market rather than just inflation readings like the CPI and the PCE. He was kind of in his standing on business today. He was leaning very heavily on the June jobs report, which showed an uptick in inflation up to 4.1%. Keep in mind, this is the first 3 months of rising inflation since 2016, if you can believe it. So that's where we start to get a little bit concerned. Seems like the pandemic effects on the economy overall are basically just, if not completely subsided yet, very much on their way to that. So hallelujah, the new age is finally here and we absolutely love to see it. Let's go ahead and move on into some of our big stock movers of the day. Anybody out there a Lion King fan? I recently watched The Lion King because it's a phenomenal movie and I have to prepare for kids movies for when my child arrives later on this year. So that's going to be interesting. Nonetheless, Jumia was basically a scene from The Lion King today because Benchmark acted like Mufasa and held up Jumia like it was Simba looking over all of Africa and said, everything the light touches is your market opportunity. So nobody really covers this stock, even though it's over $1 billion market cap. But this is basically the African version of Amazon/UPS/Venmo. Really, you don't need the UPS in there because Amazon is, I think, if not the largest, the second largest logistics business in the United States. But nonetheless, Jumia is basically an e-commerce, payments, and logistics platform in Africa. It's basically the only one in the continent that actually has like continental-wide scale. They're based out of Lagos, Nigeria. And Benchmark said that there is huge opportunity with the stock, especially given the exposure that it provides to African e-commerce, which is expected to grow at a 20% annualized rate through 2030. Those are some juicy returns, if you ask me. They called it a unique opportunity, and I certainly couldn't agree more. Moving on down into our next stock mover, we have Tesla up another 3.7% on the day. Really, the absolute run-up that Tesla has been on lately is pretty impressive. It reminds me of not necessarily NVIDIA, but like old Tesla, I guess. But so the stock was down 43% from January 1st until April 22nd of this year. Since April 22nd, as of closing today, it is up a solid 85 point something percent. I forget exactly what the decimals were, but it's quite the turnaround going on right there. So really, this was obviously, it was triggered first and foremost. The downfall at the beginning of this year was triggered by weak Q1 delivery numbers. The stock had a huge sell-off after missing delivery estimates, but then in Q2 they beat to the upside. It wasn't like a huge beat to the upside or anything, but still it was enough of a surprise to drive this uptick that's been going on lately. The other big thing is after Q1 deliveries, there was an increase in short interest or short bets, basically bets against the stock that the price is going to go lower. And so obviously that is not what happened at all. As the stock continued to kind of climb back into reality, we saw what's called a short squeeze going on, which is basically when companies have to buy Tesla stock in order to cover their position against where they bet that the stock is going to go lower. So you have to buy shares to basically close out that position, just like you sell when you buy when you sell. So that obviously additional buying pressure contributed more so to the rising stock price. So that's again why we've been seeing it on such a tear lately, again up 85%. We absolutely love to see it as it's one of the largest holdings in the WSO Alpha portfolio, which once again you should definitely go ahead and subscribe to. All right, let's go ahead and move on down below into the stinky, rotten movers of the day. Here we have Helen of Troy. Now, students of history will know that Helen of Troy has caused one war, a little thing called the Trojan War, which Homer then wrote the Iliad about. It involved the Trojan horse, where basically the entire city got sacked by stuffing a bunch of Greeks into a big wooden horse. They don't know if this war is actually real or if it's entirely mythical. My bet is on real personally, just because I want it to be. But nonetheless, there's a company called Helen of Troy out there as well, and they are trying to start another war here today. The stock was down 27.7% because they had some dog shit ass earnings. They came out and earnings came in at 99 cents a share, or about 38% below estimates, whereas sales were off by 6.5%. They gave dumpy guidance for 2025. It was very lousy. Low housing turnover and shipping disruptions at their Tennessee facility were cited as the primary reasons for why. This is a consumer packaged good company. They specialize in like basic CPG products as well as things like houseware, home goods, and shit like that. So that's why, you know, the low housing turnover comes into play. Finally, we have BP. It was a great day if you're a duck living in the Gulf of Mexico, because you finally got your revenge on British Petroleum. The company is down 4.8% for the day because they're going to be facing some major impairments. These impairments you can't just rub off with Dawn soap like we see in literally every commercial every time I turn on YouTube. There's some, you know, some like those blue doctor gloves cleaning off some duck that's covered in oil. RIP to those ducks. But nonetheless, they are going to be facing quite the impairments for this quarter. They're estimating it's going to be a $1 to $2 billion hit to profits because of impairments to tax-linked assets as well as incidental contract provisions that are going to be occurring for this quarter. That's basically the full story right there. It's a lot more complicated. It's not worth reading into exactly what is causing all of this stuff. Just know that it's going to be a rough quarter for BP, but at least they're setting the stage for it. That's probably the smart thing to do for most companies. If you're going to shit the bed, at least tell somebody about it beforehand so that we can get the cleaning materials in the right place and leave this mess, or, you know, allow the mess to be cleaned up as quickly as possible. All right, finally, let's talk about athletic drinking. Everybody's favorite activity is drinking, obviously. And when we're growing up, everybody's favorite activity is something to do with athleticism. Now, it's a sad state of affairs here in the United States because it seems like as the athleticism goes down, the drinking starts to go up. Recent grassroots efforts, I would say, by the youth, the Gen Zers here to save America, things like the beer mile are showing that we can combine athleticism with drinking, but I have an even better way for you to do it, and it looks a lot like this. So if you're listening on the podcast, what I'm showing right now is a beautifully teal, blue, yellowy can for something that's called Athletic Brewing. Now, alcoholics out there might not be familiar with this company just yet, but you probably should be, because this is becoming one of the most popular beer brands in the United States. Let's go ahead and take a step back. Back in 2017, this company called Athletic Brewing was founded out of Stratford, Connecticut, the fucking worst state in the entire country. That's where Athletic is based out of. And they started out they are a non-alcoholic beer brewery. Now, in their first year in business in 2017 into 2018, they managed to sell an astonishing 875 barrels of beer. They were just a small local craft maker. But in 2023, they actually shipped 258,000 cases or barrels of beer that they had brewed. So For those of us that are, good at math, that is an astonishing growth rate of, let me see, I wrote it down earlier, 29,386% in a 5-year period, or 211.6% on an annualized basis over that time period. Not even NVIDIA's growth rate comes close to that whatsoever. And it's because non-alcoholic beverages are really starting to pop off. Now, back when the pandemic hit and we all had to be trapped inside with our families, everybody became an alcoholic in order to tolerate being around each other. Completely understandable. I would be surprised if you didn't do that. But nonetheless, that is what pretty much everybody did. And now the responsible ones among us are realizing that, hey, maybe blacking out at 3 p.m. is a problem. And that was fine, when we were all trapped inside back at mom and dad's house. But, when we're trying to start a life on our own, maybe it's not the best thing for us. So a lot of people are getting on the non-alcoholic beer wave. This isn't necessarily a new development. As we can see, it's been growing in popularity for quite some time. But over the past 3 years, it has really started to pop off because, once again, people are starting to say, maybe I should stop being such an alcoholic scumbag. Now, I wouldn't necessarily know what that thought process is like, but a lot more responsible people have. So, because of athletics growth, it doesn't take long for private equities to smell a profit opportunity and try to get the goose with the gander, whatever the fuck get the golden goose, whatever that expression is. Nonetheless, Global Atlantic came in with a $50 million check for Athletic Brewing because they purchased a San Francisco-based brewery recently, basically just to get rights for the brewery asset that it was using because they're already pretty prominent on the East Coast and trying to expand on the West Coast now. So, like I said, the company, it's completely dominant in the non-alcoholic space. They have the #1 market share. They control about 19% of volume within the non-alcoholic beverage market. Sales are growing 60% year over year in 2023, and that makes them the 20th largest brewery outright in the United States of alcoholic, non-alcoholic. They are the 20th largest. So pretty impressive stuff in just a 5-year period to be growing in that direction. Now, given that, Bud Light fucking shot itself in the head a couple of years ago, I guess there was a bit of a market opportunity to kind of slide in and steal some of those sales, but it's impressive that it was done by a company that doesn't have any alcohol in it. Now, nonetheless, Global Atlantic, they smelled that growth. They wrote a $50 million check that basically Athletic Brewing said they plan to use that for renovations to get better designs or better packaging systems put in place. And ultimately, they are looking to double their brewing capacity here in the US by the time that this whole process of renovations and renewals is complete. So it's just going to get even bigger. I'm just glad to know that despite my advanced age and knee problems that I discovered I had at my softball game last night, it is still possible for me to be athletic. All I have to do is stop being such a scumbag. Hope that's a lesson that everybody can take home for the day. We are just about done, but let's go ahead and finish up with our quote of the day. We got a long one today, and because we were talking about non-alcoholic beers, I wanted to talk about this guy whose last name sounds like drunk, but is actually Druck. So it seems like drunk, but it's not drunk, just like non-alcoholic beers. Jokes are always funniest when you have to explain them, just so you guys know going forward. All right, so Wise Investor says, Mr. Stanley Druckenmiller, my personal favorite investor of all time, a student of George Soros, billionaire, genius, whatever. He said, the first thing I heard when I got into business, not from my mentor, was bulls make money, bears make money, pigs get slaughtered. We've all heard that expression. And then he goes on to say, I'm here to tell you I was a pig, and I strongly believe the only way to make long-term returns in our business that are superior is by being a pig. Non-common advice that you tend to, not hear too often. Definitely not advice for the everyman. Keep in mind, Stanley Druckenmiller is also the guy who said, I prefer to keep all my eggs in one basket and watch that basket very closely. One of the hardest quotes I've ever heard in my entire life, but definitely not advice for all of us out there. So be careful as you go. And as always, don't listen to investment advice from a company that uses literal monkey shit as downvotes or dislikes on our website. Like I said, that about does it for us here today. We went a little bit longer at about the 19-minute mark, so sorry for making you suffer through all of that. But it is now 8:17 p.m. I am going to go hit the hay, even though it is currently still light out. Daddy needs his sleep time. What can I say? All right. Happy investing, happy trading. Bye now.